Good afternoon, traders. Today is September 15th, and we continue to slide downward in the major markets in anticipation of the Fed rate decision next week. One thing I want to point out here is that we are still holding up at moderate support. Fibonacci Price Theory still suggests that we're in a moderate uptrend. We've taken out this high here and this high here and an extensive rally here. This establishes a new bullish trend. We've come back. We've kind of danced around this low here, but haven't taken out this low here. This 37.60, 37, call it 85 level would be the next downside target we need to be worried about. And at that point, we would establish a new low, particularly if we take out this recent low right here around 38.90. So we've got to be very cautious as to what's going on right now. The markets are generally biased to the downside, anticipating the Fed to raise interest rates, which could prompt another big leg to the downside. So understand that if we were to consider, some downside legging from this particular point here, if we were to take a look at this leg and or this leg, and simply duplicate it and drag it back over to here, another downside leg at this point could put us anywhere down in this area, 35.18, or if we want to say that it originates from here, from this recent peak up here, that would put us down around the 34 or 33.47 level. I would prefer to measure from this upper peak up here, simply because this is the current upper channel, and that puts me right down into my original wave 4 correction. Remember, I was expecting this to be A, B, C, D, E, all the way down here. This would be the end, or I should say wave 5. And if we get a breakdown, it takes out these lows, then ultimately we're looking at 34.80, 34.75, maybe even 34.60, potentially down to this 34.13 level before we're going to find support. So we're at kind of a make or break scenario for the markets right now. Let's take a look at gold. Gold was down fairly heavy today, retesting these lows. It's very difficult to see on this daily chart. I'll move it to weekly. Remember, I anticipated that there was going to be a September 6th to September 8th major inflection point. And I believe that major inflection point came and went. Believe it or not, I had no idea, but the Queen died during this time, and we ended up getting news that the Fed and inflation would likely continue to push rates higher. So now we're really looking at this low, and it's very interesting when you take a look at these lows back here and these low across here. If we were to just pick an area right in there, that comes in very, very close to where we're at the close of trading right now. And that, again, ladies and gentlemen, is what we need to be cautious of. The gold could dip down into the 1600 level, come back down here to these COVID areas, set up some sort of a washout, and then attempt to make another move. So we could see a broader downside move in gold before we see some upside move. It's still holding up overall quite well. And additionally, silver, which has rebounded off of these recent lows down here, back into the COVID areas, and this is something that's rather important to pay attention to. This low right here is back into the COVID 2019 price levels. So we're at a point right now with silver where we could see some strength continue. We need to see how this plays out compared to gold, but understand that with gold, we are already dancing down into the COVID. This is the COVID area here. Silver's already down a bit further, call it 16. If I were to draw a line, is approximately where silver is right now. It'd be approximately right there. So gold potentially could move to the 1629 area, attempting to flush out like silver did before attempting to find any real support. I'm still saying that gold and silver are excellent hedges right now, even though they're moving downward. I believe that generally the trend has been continued upward trending for the past 5+ years. And I think that we're watching right now is a shift before, as I've mentioned many times before, if you were to ask me where we're at right now, I would say that we're in this area, this 2003, 4, 5, this sideways shift, or this area, or potentially this area. We're in this broad sideways shifting taking place in an uptrend. And what I believe is going to happen is we're going to see metals form a solid base, attempt to move higher on fear. And I really do believe that what we're seeing here is a very broad ranging formation here where it's kind of drifting downward, drifting sideways. Once it finds that momentum and starts to move higher, then we're going to see a very big breakout to the upside. Crude oil down very hard today. Let me spread this out. Crude oil was down almost 3 3/4%. Come over here to a daily chart. This is showing lack of demand. This is showing deflationary pressure. You can see this rotation back to the downside. We need to see it move back down here to around 80, maybe a little bit below. That would be a good solid confirmation that the Fed is doing their job and taking the inflationary pressure off of the markets. And let's quickly take a look at the transportation index. Transportation index has rolled considerably lower, moving out of this apex formation, this flagging formation. You can see here we've got an A, B, going to be coming down here to C, which we're almost there. Likely to attempt to move a D move back up and then an E move out. So we're looking at downward trending in the transportation index, which is showing that the economy is weakening and that we are expecting downward trending to continue. We need to see how this plays out because we have the longer term pattern, which is the yellow formation, and then the greenish cyan formation is the more immediate formation. So you can see here we've got kind of an A, B, C, possibly D, and then maybe an E move out here, which would put us in February, March of next year, whereas the current downtrend is an A, B, C, and then possibly D, and then E with a breakdown move. A breakdown move, if we were to look at a breakdown move, would be similar to either from here to here possibly, or from here to here possibly, and either one of those would be quite dangerous in terms of downward trending. So we need to be aware of the potential here. A downward move equal to the first wave here would put us right back down to the 210 level on IYT. A more extended downward move would push us way back down into the COVID areas again. This is very similar to where silver and gold may be targeting down in these early pre-COVID 2019 lows. And again, this is what we're looking at as a potential downside move here. We're looking at a very strong potential for a breakdown in trend. It doesn't look good knowing that the Fed is going to potentially raise interest rates next week. I think the markets are going to react to that in a way that could be fairly dangerous to the downside. So pay attention. We're really looking at these recent lows again. The way Fibonacci Price Theory works is that price is always seeking to establish a new high or a new low. So if we take a look at this IYT chart, drag it back over here, we're right here in the middle. We're right in between this high and this low. These are unique standout lows and highs. So price would have to come down and take out this low to establish a new downtrend, or come up above this high to establish a new uptrend. And that's where we're at with almost every chart. Let's take a look here at the ES again. Spread this out. You can see we're in a very similar pattern. We're forming an apex here. We have a high price up here. We have a low price down here. We would need to see price move below this critical support level, try to break below this level to establish a new low, try to break below this level up here to establish a new high. This right now is a bullish trend because it was able to take out this high and this high. So we're in a bullish trend right now, but we are very cautious of this move to the downside. Essentially, the ES or the S&P could move all the way back down, form a double bottom down here at 36.45, still technically be in an uptrend, breaking all of these pennant formations that I've drawn, and we would establish a new double bottom formation, extending this broader formation and waiting to see what happens next. So we need to stay very, very cautious. The markets are not showing anything positive right now, and given what's going on next week with the Fed, I'm going to suggest that we're going to see more volatility and potentially more sideways price action as it tries to hold this level. If it can hold this level, the 39.35 level on the S&P is critical. So we need to see what happens at this level right now as we go forward. All right, guys, follow me on Twitter, follow me on YouTube. But let's remember, the systems are doing what they're supposed to do. We've been properly hedged and protected against this move for many, many weeks and months. If you're following my advice, you're already trading a very small portion of your capital in stocks. You've got most of your capital hedged in cash, gold, and bonds. We'll see how this plays out. Next week should be very interesting.